Turning now to corporate news, Disney just released quarterly earnings. While the company's online presence is turning a profit for the first time, its parks look like they might be in a bit of trouble. Let's break down some of those Disney earnings now with Anthony Chan, former Chief Economist at JPMorgan Chase. Anthony, always great to have you on the show. Thank you so much for joining us. Disney has been playing whack-a-mole with its various divisions to make it a more profitable company. Fiscal third quarter earnings delivered revenue up 4%, EPS a beat at $1.39 versus an estimate of $1.20. Do you think we're seeing Iger's strategies working with these results?
Well, I think you're seeing a company like Disney really working really hard to get all its units to actually move towards high profitability. But at the same time, they have to face the reality that the consumer is a bit tired and in fact, a bit stressed. And so they're facing the same kind of headwinds that a company like Airbnb is facing. And that is that the consumer is spending, but maybe not at such a fast pace. And so if that happens, it's going to hit areas like the parks, that even when consumers go to the park, they don't spend as much. But at the same time, Disney's trying to deliver a very nice experience. So they're spending a lot of money. So they're going to have to cut back on those costs in order to maintain those profit margins. And the fact that Disney actually said that they're seeing stress with the consumer really tells investors that in the next couple of quarters, don't expect much from parks. And that was a disappointment.
And, you know, they just announced that in October they'll increase the prices for its streaming services. Is that wise, given what you've just said, that we're facing a consumer that's weakening a little bit in their discretionary power?
That's true, Karina. But on the streaming side, they're actually doing well, and they actually reported profits ahead of schedule. They said that it would be another quarter or so before they reported a profit, and they're reporting profits right now. Disney's actually being very smart with its streaming because they have two services, one with ads and one without ads. And of course, the one with ads is very cheap. And so they are basically trying to sell the same service to both segments of the consumer population. Those that are strapped financially will go with the one with the ads, and those that basically want a little bit more excitement and not have to deal with the ads, they pay a little bit more. And Disney has said that they're indifferent, which is another way of saying they're probably going to make as much of a profit if you use the ads or if you take the other option without ads. And that's a very smart strategy on the part of Disney.
Anthony, I want to stay on streaming for a second because it's become such a cutthroat area among media companies, a big part of their future. And Disney's combined streaming platforms, including Hulu and Disney Plus, turned a profit for the first time ever. How did they get there amid such tight competition? And what can you tell us about subscriber numbers domestically and internationally?
They actually did well on the subscriber front, but again, what they're doing is delivering quality content. They, of course, had two big movies. You saw the Inside Out 2 and, of course, the Deadpool movie. Those movies are generating a lot of buzz among consumers, and so that gave them sort of the energy and the enthusiasm to raise rates because they feel they're delivering better quality content. And by the way, they are. So a small increase while keeping those two price products with and without ads allows them to squeeze that in. On the parks, they don't have that luxury.
Staying in that vein of entertainment, how is it performing in that space compared to its competition, which is becoming a leaner group now that Paramount Plus has merged with Skydance, for example?
That's right. It is a very competitive area. Of course, the gold standard is Netflix, and they obviously can't compete with a company like Netflix. But the fact that they're making a little bit of progress, but again, let's not get too excited. The profits they got on streaming is still very, very small relative to their overall profitability. And it's still very, very small relative to other competitors, but they're making progress. And that I think is encouraging, but they're not home free yet.
Yeah. And how much of a shackle is its TV division? There have been a lot of job cuts there, another round just announced by them. Is that the company's weakest link, do you think?
That is a weak link. Of course, they still have problems with ESPN. So they do have a couple of weak links. The legacy linear TV is a real problem because it's not a growth business. And then them buying Hulu, the remaining piece of it, there's even uncertainty around that. Disney actually mentioned that it could cost a couple $2 billion more there at the end of the negotiation. That's going to be a problem because they are really focused on trying to cut costs by up to $2 billion. But if they have to pay an extra $4 or $5 billion for Hulu, the remaining part, that's going to be a major headwind for Disney. That's something that investors are going to be watching carefully to see how those negotiations go.
And it's all happening as the consumer starts to slow down. We'll have to see where it all ends up for the next quarter. All right, Anthony Chan, we'll leave it there. Thank you so much.
My pleasure.